Alright guys, so in this session we are going to talk about this topic, that US Fed Reserve cuts interest rates. So it's been a long time that this discussion is going on, that inflation is now getting stabilized, and there can be a possible rate cut, and the expectation was around 50 basis point, and exactly 50 basis point cut was there. And there was an indication also that in future, in November December months, there will be another 25 basis point cut again that can expect in the future. So in which context this rate cut was there, and what could be the implication in US economy and in the entire world economy, and especially when it comes to Indian economy, how it can influence or impact is what I'm going to discuss actually. So if you see, it's almost 23 months that because of inflation consistently they were increasing the interest rate. So what normally happen is, this interest rate always need to be associated with inflation. So you need to understand in that way. So when inflation is going up, inflation, if it is demand pull inflation, that means if it is caused due to the money supply. So when demand will come, it is because of the money supply. So if inflation is there, you need to stabilize inflation. That is very essential for the economy. So what you need to do is, you need to bring down money supply, as money supply is causing the demand. So how to bring down the money supply? Make borrowing is expensive, or make the cost of money higher, so that you won't borrow, or for that you will be increasing the interest rate. Now when you are increasing the interest rate, it can affect the growth also. So on one side, you will be able to tackle the demand, or you may be able to reduce money supply, but the borrowing need to be done by the developers also, or the production companies also. So for them also the cost of borrowing will be higher, so supply will come down. Again, that can lead to a lot of effect, right? Ripple effects will be there, growth will come down. So it cannot be there for a long period of time that you keep on increasing the interest rate. At one point of time, if you realize that the inflation is stable, that's the prime concern, then you slowly cut down the interest rate, so that you will be able to promote the growth. And if growth is there, employment opportunities will come. Okay, again, when growth is there, employment opportunities come, wages will come, then what will happen? Salaries will come, automatically money supply will come, that lead to inflation. So this is actually a chain reaction that you need to understand. So if growth is there, it is essential, and it is expected that inflation will automatically come. If you try to tackle the inflation by reducing money supply, growth also will be reduced. So both are inversely proportional, growth and inflation. So if inflation is high, you will have to take measures, so growth will come down. If growth is high, what will automatically happen? Inflation will also go up, right? So that relation you need to understand, and let's discuss this. So Fed Reserve rate cut details. So pre-cut rate, the interest rate was between 5.25 and 5.5 before the cut. And rate cut, the Fed Reserve reduced rates by 50 basis point, 0.5%. New rate range, the new interest rate range is now between 4.75 and 5. See, after 2020, rates were drastically cut to near zero during the pandemic. Now see, what happened is, immediately after COVID, you need to have, the market have crashed and everything. So you need to give some stimulus. So what the Fed have done is cut the interest rate, so that the productions will come and the growth will automatically happen. So what is done is the same actually. So what is the offshoot of that? Inflation will automatically come. So post-pandemic increases, rates were gradually increased to combat the rising inflation. So during the pandemic time, what is required during the crash? You need to promote the growth. So rates were consistently reduced, and it almost came to zero. Now the investments will come, the productions will come, automatically employment opportunities will be created, people will have money, people have some spending capacity, so the demand will increase, inflation will come. So because of this rate cut, inflation have increased. So to control the inflation for a long period of time now, they were increasing the interest rates. Now current cut, this makes the first rate reduction since the pandemic began. So for a long time, this is a reduction. Now if you look at the Fed decision making process, it's a 12-member committee, and Fed Reserve has 12 members that votes for rate decisions, and it's based on majority and consensus. And voting results, 11 members agreed to rate cuts, with only one dissenting the vote. Okay, so future projections, further rate cuts is totaling around 50 basis points are expected before 2025. So as I've told you, first there can be a 25 basis point cut, and then after that also another 25 basis point cut you can expect, because the rates were consistently increased over a long period of time. So that's affecting the growth, and to promote the growth, this is now essential. The political implication, government pressure is there. Why government pressure is there? Government and Fed will be always in tussle. Just like in our case, if you look at in India, RBI and government will be always in tussle. RBI want to control inflation, government want to increase the growth. Only if growth is there, you will have employment opportunities and the citizens won't complain. You also get GST and the taxes. Right. So if RBI do, increasing the interest rate, what will happen? The productions will come down, growth will come down, and government is not happy with that. So government and RBI is always in tussle in India, exactly the same here. So government pressure is there. Political parties often pressure central banks to lower rates for benefits, their own benefits. Even political interest is also there, right? Election impact, lower rates can potentially boost the economy, benefiting the ruling party in election. Now, opposition concerns, Donald Trump warned against rate cuts, fearing it may benefit his political opponent. Impact on US economy, lower borrowing cost. Reduced rates make loans for businesses, homes and cars more affordable. So now, as I've told you, the cost of borrowing will come down. So more money, power will be there, more demand will be there. That can lead to increase in production, that can lead to a lot of spending, and that can lead to higher GDP also. Increased spending, lower interest rate encourage consumers to spend more, stimulating the economy. So that's why I've told you it's an economic stimulus. So when you want to stimulate the economy, what you can do, you will be reducing the rates. Economic growth, the overall effect will be the growth of the economy. So the global economic impact, increased investments. Lower US rates can lead to increased investments in developing countries. Now see here, what will happen is, let's say their interest rate is less. So you can borrow money at 4.75. Now even if you park that money in some other country at a very safe investment where you get some 7%, 8% fixed deposit itself, right? Then you will be, that difference is your profit. So you can borrow at a lower price over there if you can get it, and then you invest in other countries. So what will happen? That leads to incoming of forex in other countries where they find opportunities. So this is a situation where a lot of FIIs can come. Remember, a lot of FIIs can come, they can invest, and the markets can boom in other economies. So for example, in India, what they can do, take money at 4.75, you borrow, invest here. Why? Because you'll be in India, more interest rate is more. So that difference is their profit, right? So I hope you understood. So there is an incoming of capital here. Now all of a sudden, if they increase the interest rate, what will happen? Then they find it attractive to take this money back and invest over there. So that lead to a flight of capital from these countries. So that's why FIIs are always not good for the country. It is good that it is bringing dollar to the country and bringing forex and everything is good, but it can be taken back at any point of time, depends on Fed decision. Global growth, that leads to other economies also to grow because more and more money will come. Benefits of, export opportunities, increased US demands can boost exports from countries like India. See, I've told you, when interest rates are reduced, demand will grow up. Why? Because now they can get money, the cost of money is less. So the demand will be there, consumer spending will be there. So that can lead to export opportunity. So they are willing to buy, so we can export. So other countries also getting that opportunity of exporting. And while exporting, what's the advantage? We get forex. Okay. So currency carry trade. Okay, US borrowing, investors borrow at a low US rates. I have discussed this. Foreign investment, they invest in higher yield markets like India, borrow at lesser interest over there, invest in countries like India where you have a higher interest rate, and profit the interest rate difference. That difference itself is it's a very simple, easy game to play. Borrow money over there, invest here, and that difference you'll get the profit. So dollar inflow, increase foreign investment, strengthen the Indian rupee. So that I've told you, why more dollar comes, that will actually strengthen the Indian rupee. Now understand, it all depends on demand supply. More the incoming of dollar, what will happen? The demand for dollar will come down because it is coming more and more. So demand for dollar comes down means that lead to strengthening of rupee, appreciation of rupee. RBI intervention, the Reserve Bank of India buys dollars to manage currency appreciation. This intervention increases India's foreign exchange reserve. So at the same time, forex reserve will also boost up. RBI monetary policy response. So current RBI repo rate is 6.5. That itself is a 2% difference, guys. Okay. So last rate cut in 2020 during COVID. Yeah. Next MPC meeting is coming 7-9 October. MPC means Monetary Policy Committee. So expected action, there can be a possible rate cut this time. So they were, for us, they managed it like the same status quo for a long period of time. So now we are expecting a rate cut in the next. Now RBI stands on following US Fed. Independent policy, RBI Governor Shaktikanta Das state that they don't follow other central banks, whether Fed decreased or increased or they maintain status quo, it is not going to affect us. We completely look at our economy, our growth, our inflation, and then we decide accordingly. And our priority is always price stability. That means inflation targeting, inflation control is a prime importance. After that only you will look at growth. So that's the reason why increased after the pandemic and then maintain status quo. Now if you see that inflation is stable, so there is a possibility of rate cut. Global influence. However, US Fed decisions typically influence global monetary policies. Balancing act, RBI must balance domestic needs with global economic trends. Challenges for India, inflation control, RBI must balance growth stimulus with inflation management. See, the point is if RBI cut the interest rate, what will happen? Again, the same thing, it can lead to higher inflation. So that is a side effect. You cannot, if you target inflation, then growth will come down. If you promote growth and go with the stimulus, then inflation will go up. So that you cannot compromise both actually. So a balance need to be there. Now currency stability, maintaining rupee stability despite of all these global currency fluctuation is again very crucial, and RBI can do through various operations like they can buy dollar. Okay, that way they can do that. Or they can sell dollar. If RBI want to appreciate rupee, they can sell dollar. If RBI want to, depreciate rupee, that won't happen. They can buy dollar, like that they can do. Our economic growth, stimulating growth while managing external economic pressures remains again a challenge. Now, global economic context, US economic strength shows resilience influencing global markets, of course. China slowdown. China faces a real estate crisis and economic slowdown. And opportunities for India. India may benefit from shifting global economic dynamics. Future outlook. Short-term impact. Immediate effect on currency markets and future foreign investments. Yes, of course. Medium-term adjustments. Central banks globally may adjust policies in response to this. I've told you, even RBI is also plan accordingly. Long-term trends. Potential shift in global economic power dynamics. That's it, guys. I hope this topic is very clear. So the point is, from COVID, they have not decreased any point of time. They were increasing to control the inflation. On the other hand, if you look at India also did the same thing. But now, for some time, they were maintaining status quo. India also maintaining status quo, the same level. But now, Fed cut the interest rate. Okay. Now, RBI MPC committee meeting is also coming. So we can see there can be a possible rate cut again by following the trend. Because we need the growth also. There is a recession fear also which is there. Right? So there can be a potential stimulus which can be expected. That's it, guys. Thank you so much. See you soon.